So what I'd like to do is, Greg, why don't you give just a quick bio of yourself and a background, as your expertise around the topic of growth and exits.
Okay, great. So again, my name is Greg Alexander. I have a family office called Capital 54. I'm the chief investment officer there, which means I decide which entrepreneurs to bet on. My expertise as it relates to this topic is two things. First, I started, scaled, and sold the firm myself. So I completed the entrepreneurial journey and hope to share some perspective on that. And now I'm on the other side of the desk, and I make investments into emerging growth companies. And I hopefully share some thoughts for you from that perspective.
Great, thanks for being with us. Matt, could you give us a little background about yourself and your firm?
Sure. So Matt Bowman, great to be with everyone today. I'm with Tritium Partners, which is a firm based out of Austin, Texas. We're very much a growth-focused private equity firm, and I guess I'm going on close to 20 years now of investing. Originally, our team was part of Austin Ventures, and we were the growth equity team there before we started Tritium separately about 8 years ago. And very much focused on founder and entrepreneur-led companies and partnering up with them to accelerate growth. And with that, obviously there's liquidity and a certain aspect of an exit that goes along with us coming in as investor. And so looking forward to the discussion today based on my experiences, at least.
Great, thanks, Matt. And Steve, can you give a little background on yourself and the investment banking part of Raymond James?
Sure. Nice to see everybody. My name is Steve Hufford. I'll do this kind of chronologically through my career. You can see a lot of different perspectives that I've had on M&A transactions and IPOs and other, sort of liquidity events. I was an M&A lawyer first in my career for about 13 years. I moved from that in the late 90s into a corporate development role with a NASDAQ listed company here in Atlanta, coming to you from my office in Atlanta. So as a corporate development officer, I was essentially a corporate buyer of companies, worked for two different companies that were both in kind of consolidation mode at the time. Then I left and became an entrepreneur with a buddy of mine. We founded a couple of companies and we sold them. That took me through 2008. As of 2008, I joined Raymond James as a technology investment banker. I was focused almost exclusively, on payments and banking technology and other things that broadly fall within the category of fintech. I did that from 2008 to 2017 on sort of a full-time basis. And then in 2017, the firm asked me to move into a chief operating officer role. So now I work with my colleague and my boss, who's the president of our global equities and investment banking business, to administer roughly 450 bankers that are located in 21 offices throughout the world, actually. So we get a pretty broad view of what's going on in the M&A and public securities markets.
Great, thanks for that. And as for the combination of the attendees and panelists, we're going to go over a little bit about the markets that are now going on now, what it takes to form a company within the market segment and market sectors we're in now, management teams, and then what are things that are going on around the market that might help, entrepreneurs and entrepreneurially serving companies that help entrepreneurs and scaling companies to achieve that exit. So, and one commonality with Matt and Steve is that Matt was an investor in the company GAIAC, and Steve, I believe, was the banker that helped sell the company to the member company GAIAC to Refinitiv, now London Stock Exchange Group. And even if Steve and Matt, while we're doing this, if you want to use, a lot of people in the audience know of the company and know of the success it had, but even using them as a little bit of an example of some of the good stuff to do in the process, I think that might help some people. So number one of the themes that we were talking about is I'd like to start maybe with Matt and thinking about, the themes in technology that you're seeing right now in terms of trends, themes that are, more prevalent or less prevalent based on the current market.
Sure. Again, when you isolated on the technology sector within our economy, it's hard to say that there are pockets that aren't of interest in technology right now. I think across the board, you can look at a lot of different sectors and see a lot of disruption that's happening in existing industries, and also new markets that are opening up. And technology is obviously the catalyst to all of this. And we as a firm, we invest across a handful of sectors and within technology, and we're even sort of expanding out into other sectors where we haven't spent as much time. So an example is we're closing our first ed tech deal this week, which is exciting for us, and a lot of it was supercharged with COVID and some of the at home and new sort of learning methodologies that needed to be put in place. So there's a lot of opportunity that's happening in ed tech right now, but across our sectors in various vertical software, fintech, information, data analytics, AI, a lot of these sectors are very healthy and have been healthy in the past, but have had a catalyst with COVID in a lot of respects that have advanced the usage of technology and the way that it's being deployed in ways that I think is pretty exciting about the future and where some of these sectors are going. So I can't say there are any specific areas that I think are leaps and bounds ahead of other industries and others that are kind of falling behind when you look at it, solely on a kind of a tech basis. I think just the backdrop of what's been building and the COVID impact here is really supercharging tech more broadly and creating a lot of new innovation and a lot of exciting opportunities for me as an investor, thinking about all the entrepreneurs and founders that even over the last 18 months or so had some extra time maybe on their hands to think about innovation and new ways to do things. And I think that's going to create even more companies and opportunities going forward. So I think it's a really exciting time to be in tech more broadly.
Ted, did you want me to pick up on that a little bit?
Yeah, that's actually, I was trying to find the unmute button, Steve, and
okay,
ask
no
you
problem.
about, so talk about a little bit, Steve, the market in terms of how frothy in the private equity and the amount of money that's flowing in. If you said, okay, Matt's saying, okay, you can do almost anything in tech, and COVID kicking back in probably accelerates that even more. Talk about just the environment of money going in and money coming out and all that.
Yeah, glad to do it. By the way, I just kind of to piggyback on the comment that Matt made, I've heard folks say, and I think it's probably true, that COVID advanced the technology exit marketplace by probably about 10 years. Matt and I both involved in Gaiac, which was a fantastic company that Melissa Townsley Solis built, founded and built. And they were a great company before COVID. COVID had the effect of kind of continuing to influence their numbers positively. The digital education realm that Matt was talking about, cybersecurity, all areas where we see the market really behaving in a very robust way. Ted, to some of the comments you were making, I picked up some stats this morning from a Bain & Company private equity report that came out within a week or so ago. I'll reel a few of these off pretty quickly. If you sum up private equity deal value, exit value, and fundraising, it is on pace to approach or exceed $1 trillion by year end. That would be a record. Deal value for the first half of the year, $539 billion, which is on par with the full year average since 2016 of 543. So through half a year, we've, generated as much exit value, deal value as we normally do in one of the last 4 years. And several of those last 4 or 5 years have been pretty strong years. Industry dry powder in the private equity marketplace, new record of $3.3 trillion as of June 30th. That doesn't include SPACs, special purpose acquisition companies. There are 420 roughly of those on the market right now, with $133 billion additional to invest. Exit value for the first half is almost $500 billion, which is 10% more than the full year 2020, higher than any other full year with the exception of 2014. And global fundraising for the first half of the year, $631 billion. So we're really on kind of an amazing trajectory for 2021. We just finished our internal reviews of our business units to begin to look at what they're looking forward to for next year. And I don't know, how far into the future this marketplace will last, but we're a 9/30 fiscal year. So when I think of our first fiscal quarter, it's actually the December quarter. And that quarter, as we look at it over here, is really full from an investment banking perspective. So we're in a kind of a unique market right now. It's probably as, I don't know if you want to use the word frothy, it's certainly as built up as any we've seen in quite a while. And at the moment, anyway, it appears to have a bit of staying power, at least through the end of the year and perhaps beyond.
Got it. And let's, Greg, I want to ask you a question. When you think about the market now, how hot it is, and in anything in tech, and you deal in a ton of service companies as well, where do you see the market for, I would say, both small deals and even tech-enabled services?
Yeah. So the real question is what's tech and what's a service these days? Those lines are blurring tremendously. The tech-enabled service or the managed service provider that uses technology as a way to bring scale to a service company that might not have scale previously. So tremendous activity in that space, much like in the technology space, lots of capital that are attracted to that because of the economics of it. Very sticky customers, great gross margins, excellent unit economics. And there's just a lot of capital looking for a lot of deals. I'll give you an example. So Tad, you and I are in a group called Collective 54, and it's a membership organization for services firms. And one of our members, a guy by the name of Zach Schuler, started in a company called Ningio. Ningio does cybersecurity awareness training. Traditionally a training company. Well, now because of technology, they're an ed tech company. And they sold to Gage Capital for a record deal. And his time from cradle to grave was 6 years. So what's happening is because of technology and its creative use by services firms, what used to take maybe a generation to scale a firm is done in less than a decade now. And when you inject it with growth capital, you're pouring fuel on the fire. And this asset class known as service companies that were, historically speaking, tough to invest in because they were people-driven businesses. Now they're investable assets because of the scale effect of technology. And we're seeing that all over the place. So anybody that's listening or participating in this call that is in the services sector, managed service provider, tech-enabled service, you're in the right spot. And I think some of the things that Steve and Matt are seeing in their niche, I'm also seeing in my niche.
Got it. And do you guys think there's any difference in the investment theme versus the exit themes right now in terms of, you said, broadly in the market, as both investors and deal people?
Well, I think like any entrepreneur or founder, as an investor, kicking off a new investment, you always have to think about, what an exit looks like. And candidly, a lot of it comes down to, your plans and, what you think the company should look like, and who the likely, acquirers are. And so I think there has been, I think, a little bit of a change of late, at least from my perspective. In most cases, you're typically thinking more of a financial buyer transaction or obviously a strategic acquirer. I think, with the door opening of sort of the IPO market and SPACs in general, it's created opportunities to maybe think a little bit bigger and longer in terms of how you might want to scale a company to achieve sort of a liquidity event in the public markets. So I do think there are some nearer term dynamics, and none of us will never know exactly how that will play out longer term. But I do think that window sort of really opening up as wide as it has been of late, and the amount of liquidity in this market looking for opportunities and for growth has created some opportunities to think a little bigger and broader, and think about some of the plans that you could put in place in terms of when you might want to exit and what that might look like. And I don't know, Steve, if you want to jump in on that, but that has sort of been a new impact of the market of late that has really helped catalyze some of that deal activity that you mentioned.
Yeah, I'll jump on that one, Matt. You're making some great points there. It's interesting if you kind of look at this on a longer term sort of historical perspective, in that back in the late 80s and early 90s, we used to take relatively small tech companies public. That was kind of a feature of what that world looked like back then. Sarbanes-Oxley came along. There were some other forces at play, although I think Sarbanes-Oxley, which was a federal and SEC rule basically that made it harder and harder for small companies to go public, essentially had a tendency to kind of close off that IPO market for the small companies and sort of push everybody towards an M&A market. And most of the private equity guys like Matt, if you're thinking about this through the, say, early 2000s into at least the mid 2000s, if not a little bit later, primarily looking at M&A markets as the exit venue. And now what's happened is that the SPACs have come along. The SEC has through the I forget the name of the litigation, the legislation that opened up the window there a little bit, has made it easier now again for small companies and special purpose acquisition companies to get public and make deals. And so now all of a sudden, what used to be kind of a discussion around, well, is it going to be a strategic investor or a private equity investor, is now, you want to look at an IPO window, hey, let's test the SPAC market. And so you kind of have four markets. Actually, frankly, if you look at the private equity world and you begin to break that down into subsectors of that world, it becomes even more robust than that. And all of those markets are kind of kicking on all cylinders right now. So again, to Matt's point, you get out there and there's just a lot of opportunity to look at to try to find, what's going to be my exit strategy on this one. At some level, it makes the job of guys like Matt and I a little bit harder to kind of think through all those dynamics. Matt and I had plenty of those conversations in connection with GAIAC. But it's to the benefit of the entrepreneurs who are creating these companies that they now have so many new venues that they can find to take their company out.
Yeah. And Ted, I would add to that two more dynamics, and I agree with everything that Steve and Matt has said, is the cost to start a company these days has just plummeted. So the capital, where the capital is needed is much later than it used to be. You can bootstrap your way to a decent sized company fairly easily these days, again, because of all the wonderful technology infrastructure that exists. But once you exit the growth stage and you get into the scale stage, this is when you really need the money. Why? You got to build out a robust distribution channel. And that requires investment capital. And that investment capital, timed correctly, can really scale these organizations tremendously. So I think capital, at least what I'm saying, is entering companies a little bit later in their evolutionary state. And it's a positive for the entrepreneur because they're able to hold on to their equity a little bit longer. And then when they do take equity from the chosen equity provider in all of its various forms that we've discussed today, they've got enough traction that it's on more favorable terms for them. The risk to the investor has been reduced dramatically at that point. Some of these companies are already profitable. So the scarce resource here are the deals, are the great companies to invest in. We have an oversupply of capital, but an undersupply of companies, and that's to the advantage of the entrepreneur.
Great, that's perfect. And that's what I wanted to sort of shift our talk to is talk about, because people talk about we invest in entrepreneurs, we invest in ideas in good markets and teams who can execute. So maybe if we look at Greg, you talk about what you think an investable entrepreneur looks like, how you evaluate that.
Yeah, well, if I had the answer to that one, I wouldn't be here with you today. I'd be winning the Nobel Prize for psychology or something along those lines. So let me give you my perspective. I look for three things in an entrepreneur. Somebody who scores very high on the grit scale. I'm a believer in the grit scale, which is a way to measure perseverance and passion. The entrepreneur's got to be willing to go the distance. And sometimes that's lacking. That's number one. Number two, I look for the entrepreneur's ability to build a team. It's too much work for one person. Solo entrepreneur doesn't work, in my opinion. So that entrepreneur's got to build an executive leadership team that's bankable. A group of people that you can invest in. And number three, I look at speed of iteration. These young companies, you're constantly evolving. And how well somebody listens to the market and pivots their product strategy, their distribution strategy, their business model in terms of pricing and things of that nature in response to competitors' reactions to their presence is super powerful. I find sometimes I look at companies and they're still operating on the annual fiscal year, and they have this kind of a lengthy waterfall planning process, and in some cases multi-year. In my opinion, the world's moving too quick for that right now. So a great ability, or I should say a great agility is something that I look for. And from an entrepreneur's perspective, when you're thinking about how much money to raise, if I could just add this last point, in my view, you got to raise enough money to make it through 3 pivots in 18 months. In the early stages, that's the kind of capital number that you should be looking for. And if you can't get there after 3 pivots, then you got to scratch your head and wonder if you're going to get there anyways. So some advice for the listeners on that front.
Greg. And Matt, when you look at the entrepreneur or the market or the team, what makes some of the difference in what you would say, investable for the next level or not?
Yeah, and I'll sort of piggyback off of what Greg said. In terms of an entrepreneur that's backable, I think you hit 3 great points there, Greg. And I just think that, we all come in different shapes and sizes, and we have different sort of, skill sets naturally, right? And I think that the biggest thing is sort of being self-aware around, what you're good at and what you're not. And in the areas, that are maybe shortcomings or areas you don't spike as much, that's where you really want to augment and build that team out. And I think that's what, we look for, as an investor coming in saying, look, there's a lot of great components here that's working, and that we can, continue to build upon, working with, this team that, understands the mission, has the agility and motivation and a great, entrepreneur CEO who's going to lead and set the example and the cadence for the company. So for us, typically as an investor, in terms of what we're looking for, I think Greg was exactly right in terms of the ability to bootstrap companies today. I think that is an awesome phenomenon that's allowed entrepreneurs to ultimately be more successful in owning more of the companies that they're starting with the great ideas that they have. And so most often that means that an entrepreneur a founder has come up with an idea, developed a product to meet that market need, and has sort of proven the revenue model and sort of the demands. Now, some companies will again sort of continue to sort of build out the team and achieve some sort of level of scale, and I think that's the part that everyone sort of needs to think about in terms of when they might think about an exit. Is it what level of scale is kind of at current course and speed the right timing for an exit, based on the team and skill sets and sort of know-how. For us, a lot of times we're coming in with situations where that's all in the works, and some founders and entrepreneurs have a huge sort of underpinning for their net worth, tied to the value in the company that they've created, and would like to take some chips off the table and come in and have a growth partner to play forward with, to have even sort of greater upside, and can help navigate sort of that next phase of growth and scaling, and a lot of different aspects of go-to-market strategy and other pieces to be ultimately successful. So for us, that's typically what we're looking for, is that it's a proven product, the market is there. There's validation around that, and that we can come in and through our experience and partnering up with the team, hopefully catalyze growth more. And candidly, oftentimes that could mean in thinking about some add-on acquisitions to accelerate growth in ways that maybe a founder or entrepreneur might not be able to do on their own, in terms of just sort of capital dynamics. And so for us, we like to really think big and look at what a company can become, and sort of dream a little bit, and set those goals and targets, and partner up with a team with great alignment, and really push to have a great outcome, like you'd mentioned with GAIACT, and happy to share more along the way. As a tremendous effort by the team there, and a fun journey. But it all starts with having some product and market validation, and from there finding the right way to step on the gas.
Yeah, and then you're hitting right on where I was thinking, because when you talk about markets, like if you're talking about, Steve, if you want a meaningful market size, what if there's an entrepreneur in the audience and they say, okay, I need to look at a market size that's at least X or Y. What do you think the market size that they need to be at least thinking about for meaningful scale, growth, exit?
I mean, I'd say, look, if you can't see your way to kind of a $1 to $2 billion market, and by the way, I'm not saying that it's not worth starting a company unless you can see that. But if you want to get the attention of a guy like Matt or some of these other growth investors, you want to be looking at kind of $1 billion plus kind of markets. We have Matt has seen this many times before. He's seen many a Raymond James pitch book. But we have a set of characteristics that when we're evaluating the exit potential of a company, whether that's an internal evaluation that we're making for our own purposes to think about, do we want to represent this company, or we're thinking about it in terms of how we're going to portray that company to the marketplace. Certainly, total addressable market is one important factor. Some of the other factors that we keep on our list. Revenue growth, how fast can you get the revenue to grow? What's the composition of the revenue? Is it sort of on the one hand kind of an old school license, kind of a model, or is it more of a recurring SaaS-based model? And the more you can move it in the latter direction, the better off you are. What's the revenue visibility look like? How much is under contract this year, next year, even the year after? What are the retention characteristics? What's churn look like? Greg mentioned this one earlier. What's the gross margin profile of the business, which helps you understand how profitable it can begin to get at scale? How does it rank on the so-called Rule of 40? Rule of 40 is a software technology kind of investing metric. And the 40 points that comprise the Rule of 40 are the percentage growth rate and the percentage of profitability as a measure of EBITDA margin. So if you can sum those two up and get north of 40, it's a Rule of 40 company. And that kind of connotes a certain profile in terms of growth and profitability, and also helps you to think about, what's, more growth, less profitability, or the other way around. But those are all kind of key characteristics of it that we look at. Total addressable market is certainly probably near the top of the list. Again, particularly if the game plan is to build something up that you want to take, out into the marketplace, where you would find a Tritium Partners to come alongside you and invest. Firms like his are going to need to see a meaningful total addressable market to warrant that kind of investment. Greg, I don't know if that's your business as well, but that's that's what we see typically in technology markets that we play in.
Yeah, great points, guys. And I agree with all of them. One thing that I would add to that, just building on that great advice, is, if you're looking at $1 billion market and an entrepreneur is, pitching you a deal that shows a vast market, the question I always ask is, how are you going to reach the market? If there's a lot of buyers out there, can you actually reach them consistently, cost effectively? And how are you going to do that? Like, what is the route to market? Single channel, multi-channel, et cetera. Because I find, at least the world that I'm playing in, most of the entrepreneurs at this stage know to go after big markets. They understand the opportunity cost of going after a small market, but sometimes they don't think through, just because the market's there doesn't mean you're going to reach them. And when you look at an income statement or cash flow document, most of the money is chewed up in sales and marketing. It's not uncommon for an early stage company to be spending 50, 60% of revenue on sales and marketing, because it's just, there's a lot of experimentation that has to happen there. So the advice I would give for the listeners to this webinar would be, maybe spend more time on that, the go-to-market model and how you're going to reach those budget holders than anything else, because the early adopter community is different than the mainstream market. Most young entrepreneurs get off the ground, and just through positive word of mouth and harvesting their personal networks, they get to a certain size, and then it plateaus, and they wonder, what do I do now? How do I get to potential customers who have no idea who I am? And that kind of repeatable sales motion is a critical milestone in each entrepreneur's journey. It's one thing to have a successful business in that early adopter community. It's another thing to sound cliche, to cross the chasm and get into that larger market pool in some consistent way. It's hard to do, and that takes a lot of capital. So if you're thinking about when to raise and who to raise from, draw a circle around that moment in time.
That's a great point. And by the way, just if people don't know, Greg grew a sales and marketing, I don't know if you call it outsourcing services company. So he's done that for lots of people. So probably a lot of war stories in there. So Matt, one thing, just because Steve mentioned the rule of 40, do you look at that? Say you've got a software company, or let's just say software SaaS company, and they've gotten to 10 million in revenue, and they need money to get bigger. Do you look at that rule of 40 for the that first 10?
Yeah, I think the rule of 40 is definitely something that is brought up in our internal sort of discussions in terms of kind of growth and profitability, and where the company is at. If you go back 10, 20 years, right, is almost all EBITDA based. And now, for myself as an investor, oftentimes, companies are, break even or nearing profitability, or, slightly above it. And I think ultimately, it comes down to the fundamentals of the company that we then, have to kind of believe in as a investor, that, if we take a company that's, 20 million of revenue, and we're, plans in place to grow it to 100 million or more, trying to think about, how that rule of 40 will look, 5 years forward as well, right? So it's not just sort of the growth today, and that's, kind of most often the case when we're coming in at sort of the stage that we are, but it's then, for us as an investor, once you sort of scale and you get of size, then it becomes, more important that those unit economics are proven. So a lot of work that we do on the front end is, to take the fundamentals of sort of the revenue model that's in place today, thinking about sort of the cost of acquisition, thinking about the lifetime value, thinking about sort of the needs of the company and investments that are going to be required as you go through that whole period, and really having a good handle on how you think that P&L is going to scale into the future. So just as is it important for us on the front end, and is skewed much more kind of on the revenue growth. Ultimately, as you get larger, you do need to show that profitability, that there is cash that will ultimately sort of churn out of out of the business model. And so there's a lot of work that has to go in on the front end. Even though a company, might not be exhibiting, some of those profitability characteristics, you have to really constantly think about that model. It's not growth at all costs, at least from my perspective. It's growth with, prudent fundamentals, on those unit economics that are allowing the investor to, come in and continue to put, new money into fund and grow the company going forward.
They're good points. And one of the things that kind of was in the pre-talk that we had a little bit, and it's kind of on everybody's mind now that we're sitting here still in a Zoom meeting and more Zoom meetings to come with this, Delta variant. What do you think, with COVID, and I hate to, some people will use different words for it, but COVID has been around. We've got some effects that are going on now. What are the, 2 or 3 things that you think, how that might help and maybe how that might hurt? Or if you're out there in entrepreneur land, how would you be looking at where we are again with COVID and the markets, and I'm growing a company, assuming you're growing, what are things you would be thinking about it from the both, macro and micro perspective? Maybe start with Greg and then Matt and then Steve.
Okay. One of the positives of COVID, and I think we need to be highlighting more of these because every day we wake up and read the newspaper and there's more negatives, is access to a global workforce. I've been absolutely blown away by the level of talent in places outside of North America. And I think historically speaking, in some industries, not others, but in some industries, there's been somewhat of a, hesitation or stereotype associated with the global workforce. And I think that's gone away with COVID. I think we're so much more comfortable doing things virtually. And because of that, if you can tap into this decentralized global workforce, the amount of capability you have access to on attractive financial terms is really something. And it's an accelerant for sure. There's some companies, particularly in the services sector, even tech-enabled services, they're somewhat constrained based on the access to talent. But once you open up your talent base to all the continents on the planet, the supply and demand equation starts to look a lot better. And that constraint gets removed and scale accelerates. So that's the biggest one that I see is access to a global talent base.
Great.
Yeah.
Matt, any thoughts from you?
No, I would just say, I'd say there's the other side of that coin though as well. As you're building your company, I think you need to be aware of the number of other companies that are out recruiting in markets that they have never recruited from previously, and so there is a greater amount of sort of turnover that's happening that we are seeing because of this phenomenon. And I think ultimately that's putting greater emphasis and pressure around trying to create that strong culture and fabric that makes employees loyal to the mission at hand for your company that you're looking to build. So I'm a little old school, so I kind of worry a little bit about technology and kind of detachment from the face-to-face interactions that we have, and to really kind of rally together as a team. And that really only, in my perspective, happens, more in person and having some of those interactions. So, if we continue to have, new lockdowns or anything, obviously we can power through. We've proven that. But I do think there's an important piece around that connectivity to the company and the culture and the social fabric that you really need to be mindful of at this point in time, because you can go and recruit in places and markets and hire people remotely. There's a lot of other people doing the exact same thing, right? So I don't know exactly how all this sort of ultimately shakes out, but I think that's incumbent really on the CEOs and founders and entrepreneurs to lead and make sure they're staying connected to the teams and setting the right strategy and vision, and still finding ways to come together as team. I think that's going to be even more pronounced going forward if that does happen, where it continues to be difficult for us to come together. It's something that I think should be on everyone's mind.
Yeah, I'd pile on here and say, the talent thing that Greg put his finger on is incredibly important in the moment. I think I would say there that what we've seen, by the way, if you've followed this in the investment banking industry, the talent war within investment banking is intense these days. There's lots of articles about it. We've spent a lot of time thinking about it, responding to it from a leadership perspective here. I think the thing I would say there is that ultimately I believe culture wins, because people are attracted to strong dynamic cultures. Again, you invited us, Tad, to use Melissa's company GaiAct as an example here. Melissa had a fantastic culture that she had built up there, and I remember, Matt knows this, we executed that process largely, within the COVID timeframe, and team really didn't miss a beat there. They stuck right on the task. I mean, an M&A process is a challenging process because you got your day job, which is running the business, and then you got your second job, which is communicating with investors and bankers and, kind of driving this process and answering questions. It's really like having two full-time jobs. And again, to Melissa's credit and her team's credit, they stayed right on point. So I think at the end of the day on this talent question, culture ultimately prevails. And I think that's the way we've thought about it a lot here at Raymond James, is like, what do we continue to do? Not just try to do, but continue to do to maintain a culture that is attractive for people to want to come to work here every day. The one other thing I might say about COVID, and I don't know where this leads in terms of what it means, in terms of how you build a company or what kind of company you build. But I think what we're learning with this Delta variant is, I'll say it this way, I think we all were sort of living for the day when COVID was going to be over and go away. And I think we all thought maybe 2 months ago that we were getting somewhere close to that. I think, I hope I'm wrong about this, but I believe we may be finding that COVID isn't going to sort of go away in a sort of a complete it's over sense, but rather we're going to have to learn to deal with it as a society, and we're going to have to, work through the ebbs and the flows and, all of that. And I think that will lead to new opportunities, because I actually think that's a mindset shift from where we've largely been the last 18 months. I think where we've largely been has been, we'll get vaccines out there, we'll figure it out, we'll put a rest to it, and we'll go back to life as we once thought it was, maybe with some changes to it. I think now it's proving to be something that's maybe, unfortunately, a little bit more pervasive or sticking to us more than we would have liked. And I think that's going to change the way we react to it again. Thankfully, humans have shown this incredible versatility in terms of how they deal with it. I suspect, we'll morph our ways again and figure it out. But it's obviously been a time like no other that any of us have ever lived through.
Yeah, I appreciate that perspective. So, and I remember the phrase, I don't know who said it, that culture eats strategy for breakfast every day. So,
Yeah.
And having worked I'm going to shift to something a little, hopefully some people we can personalize a little bit and take some lessons learned from GaiAct here, because I saw Melissa and Dave, and if you want to, let's embarrass them a little bit here, Matt, what would you say the couple things, if you said, golly, 2 things that Melissa and team really super did well, that you'd say, hey, if other people can do it like they did, like be like, I know the old phrase, be like Mike, be like Melissa. What would a couple of those things be that you would give advice to, entrepreneurs in the audience and CFOs?
Yeah. Be like Melissa. I like that. I always joked with her that if I could bottle her up and take her with me and pull her out in meetings, I would do so frequently. Just the passion, the culture, the motivation, the leadership, as Steve mentioned. When we were thinking about our exit process and beginning to prepare for it, COVID hit, right? And I think we as a board, there was some interesting discussions around what it all meant. And Melissa and the team said, it doesn't matter. We're gonna power through this, as a business and be successful. We'll decide exactly what we want to do on the exit side, but it's not going to slow us down. And I think that sort of leadership and motivation and sort of the team, rallying together is what set last year up to be a huge year, and is continued on this year. And ultimately, from when we embarked together with the team, setting the plans in place in terms of what our objectives are and what we all wanted to get accomplished and what we wanted to achieve. There's a lot that goes into it, so it's hard to just say kind of one or two things, Tab. But I think more importantly, having that plan and having the leadership and motivation and sort of the teamwork and alignment that allows everyone to push and have an idea of where they're headed and what they're going to accomplish. And if there's road bumps along the way, kind of so be it. You'll kind of bounce right over them and be better for it and keep going. So that was something that just the team at GAIACT had, and allowed us to increase our revenue 11, 12 times over our time together and have a phenomenal outcome. But it all comes down to team and people and having that plan in place.
I'd say I'd like to take a little bit of a shot at that one, Ted. I'd say Melissa has an incredible kind of personal work ethic and couples that with a level of care towards her employees that was fairly unique. So because of that, personal work ethic, care for employees, she was able to set the bar really high on performance, and then sort of create an expectation that everyone was going to be striving to get there. And if you fell short, she'd pick you up and help you get back. I mean, just a very dynamic sort of personal leader. You'd ask a question a ways back that I didn't get a chance to answer. So this maybe gives me a little bit of chance to take a swing at it. What are those characteristics of the entrepreneurs that really make a difference? Greg's first out of the gate was grit, which I think is a great answer and the right answer. Number one characteristic. The second characteristic, and Matt, interestingly enough, touched on this, was self-awareness or emotional intelligence and teachability. I really, again, I see lots of entrepreneurs because we're calling on them every day. And entrepreneurs who have sort of a teachable spirit are really, I think, markedly different from those that don't. It's something that's easy to pick up on early in a conversation. And the teachable spirit makes all the difference, I think, because, Greg used another word, pivot, and said that, 3 pivots in the first 18 months. Well, pivoting is in some respects a function of teachability, right? You don't really pivot until you've figured out first, oh, this is not heading where I want it to go. So some of those kind of soft emotional IQ kinds of characteristics are things that I really spend time thinking about when we encounter entrepreneurs. And again, Melissa was a pleasure to work for, just because she had a lot of those characteristics and that personal care for the people around her, her investors, her employees, even her bankers. She created some great relationships with some of the bankers on my team.
Great, yeah, and again, I know Melissa's. I think she's out there. Congrats again to her. And even we did a lot of the recruiting, and she cared for us, and she taught me things as a leading of an organization serving her. So it's great stuff that happened there.
By the way, I might add real quickly that you have not received an ass whooping until Melissa has given you one. I just want to make note of that. Melissa, if you're out there, I hope you heard that.
If Melissa's out there, she's probably tired of all this attention on her.
Yeah, she is. Well. She's about to unmute and tell us to be quiet.
Exactly.
So, all right. So shift off that a little bit. Because a lot of this is about growing an enterprise that's, worthy of investment and capable of an exit. One of the interesting questions that you guys threw out in the pre-question area was cultivating your future buyer market. Starting with maybe go Greg, Matt, and Steve, what does that really mean? And how do you see people be intentional, about that in different stages about cultivating a buyer market?
Okay, I mean, my advice would be to hire an investment banker. And the reason why I feel that way is that most founder organizations, they're first-time founders. And what it takes to cultivate a universe of buyers that might be interested in your firm, it's a very specialized skill. And if you're doing it for the first time, you're likely to make mistakes. And this is not the time to make mistakes because the stakes are very high. So there's a field called investment bankers. We have one of them with us here today, and that's what they do, and they're excellent at it. So this is something that I would say you get what you pay for, and I would outsource it to a highly capable individual and have them hold your hand through the process and teach you how to cultivate the right universe of buyers so that this company that you created and you care so deeply about lands in the right hands.
Yeah, I'd say fully agree. We thought that way specifically at GUYAC with Steve, and we actually engaged Raymond James well in advance of an exit process to help us, understand some of the inbound interest that we were receiving, and allow them to also kind of help open some doors in advance of us thinking about, full sort of green light. We're going to go into a process and find a buyer. I do think, though, outside of, as you're sort of leading up to that, I think there are things that you can do even before you start, having some of those conversations with, great advisors like, Steve and Raymond James. I think, going to industry events, doing a lot of networking, making sure you're just aware of your competitors and what's happening in the market, and developing those relationships. I'm always cautious around distractions and kind of having the team kind of detour in any sort of respect. But I do think it's important to think about strategic partnerships and alliances, because those certainly can be your buyers in the future. And the more that they sort of become more and more dependent on your company and the organization, and see the capabilities and skill sets that you have, it gives them even sort of greater confidence to step up and write the bigger check. So there's a lot of things that you can do even before the exit process, as you're nearing to cultivate those relationships and make sure there's some broader market awareness for your company. The last thing you want to do is to kind of embark on a process and everyone's sort of saying, who's that company again? What do they do? You want to get your name out there, and that's marketing, and that's networking, and having some of those conversations well in advance of even sort of thinking about an exit.
I think great points Matt's making there. I'd say there's a lot to this topic about how to think about your future buyer universe. I might kind of, to fit it in our time, just kind of talk about it real briefly in terms of strategics and then private equity. The strategics, I think the old adage about keeping your friends close and your enemies closer probably prevails there. Now, you don't want your future buyer to know everything about your business. You don't want them to know all the financial characteristics or where you came from to get where you are. You don't want them to know necessarily the secret sauce about how you may compete with them in the market. But knowing them and having a relationship with them, I think comes in awfully handy when they go to make an offer to buy you, 5 years down the road. But again, you have to think very carefully about measuring out, doling out in a very incremental way how much information you really want them to know. I think the same is true with private equity folks. One thing I would tell the entrepreneurs here is that when they are talking, and again, Matt, forgive me here, I'm not picking on Matt.
That's okay.
With whom I have a great relationship. But when the private equity guys call and they're talking to you about their numbers, particularly the young ones, because they tend to have young banks of young collars. They're writing all of those numbers down, and they're going to save those. Those are going to go in the CRM system, and they're going to be whipped out on you 5 years later. Now, that may be fine in terms of where you went in that 5-year period, but it may also be that you want to maintain the ability to tell your own story 5 years from there. And it may be that, what happened in those first couple of years before the big pivot that Greg mentioned is something that you don't necessarily want to kind of share out there. So I would just, I'd caution people not to overshare in those early years, but yet at the same time, you do want to build relationships with the guys like Matt, who can make a real difference in your company over time, or a strategic buyer that you think may be your ultimate exit. You want to have the relationships, but you want to be cautious in terms of how much detail they actually have about your business. Because again, we're going to tell a story on the time of the exit. Your bankers are going to want to communicate a story, and we're going to want to focus buyers on that story. And the rest of this stuff is extraneous information or noise that we would otherwise have to wade through. So kind of limit the noise for yourself so that when you get to storytelling time, it can be very crisp.
Great advice. Great advice by all. And I think we're getting close to the time here, and this has been excellent. I really appreciate the panelists here, Greg, Matt, and Steve. Really amazing information. And I would tell anybody in the audience, if you've got questions, I know these are open panelists. They're not hiding from anybody. So if you've got questions, I'm sure that I know they're all on LinkedIn. I know they're all out there and would be happy to answer your questions. And we're building a community and cultivating a community of companies that are growing and doing great things for the community, and hopefully growing and exiting and having meaningful impacts on the community and people. So thanks again to big thanks to Matt, Greg, and Steve. Congrats to to Melissa, who is out there. And I want to go over here as a last part of the Zoom meeting here is our tech industry lunch, which is a great, luncheon, is on the 20th. It's a week from Friday, and it's going to be how AI is changing the way we shop. And the CEO of Spacey, which is also a Dallas-based company, Skip Howard, and will be speaking on Friday the 20th. Then the Tech Tuesdays will kick back in on the 24th and the 14th, where we've got a health tech topic there on the 24th, and then looking at data breaches investigation there in September. So check out Tech Titans website for any other details, and great job to all. I hope all the the attendees got a lot of value, and I appreciate it. And it's great to see people that we know, and hopefully I'll be seeing some of the Dallas people in person at some point here pretty soon. So thanks again. Anything else from Bill or Shannon?
Tad, just thanks very much to you and the panelists for a great discussion today. Many times as I've been through these discussions and also, help groups invest, I always learn something new, and that's always helpful. So there's always a good takeaway. But, stay engaged with us. We got a lot of great programming coming up, and keep your fingers crossed that we'll all be back together in person without a mask here sometime this fall.
Thanks, Bill. Well, thanks again, all. Have a great day, and be well.
Thank you.